Welcome, I'm Donald Leggett and I'm joined by Keith Hiscock, CEO at Hardman Co, the corporate research and consultancy firm. Hardman have just published an influential piece of research called Share Ownership for the Many, Not the Few, an in-depth analysis of share ownership trends across all UK stock markets. Okay, so why did you do the research, Keith, and why did you involve Argus Vickers, the shareholder register experts?
So we did the research because every 2 years the Office for National Statistics, which is the government's number crunching department, publishes its own survey looking at ownership. But actually it's quite restricted. It only publishes it every 2 years. It uses data that's a year out of date, so the latest one uses the data to December 2018, and it doesn't even look at the NEX market. It uses a sample of 200 companies, which obviously is only a sample, quite accurate for FTSE, but the further you get away from FTSE, the less accurate it's likely to be. So we thought there was an opportunity to supplement the work of the ONS by looking across the whole market. So our survey with Argus Vickers covers every stock in the market. We haven't used a sample, we've taken every stock in the market and looked at it. It looks not just at the London Stock Exchange, it looks at NEX as well. It's conducted every 6 months, and the latest data we've got is June 2019. We used Argus Vickers because Argus Vickers has got a long history of understanding shareholder databases, and in particular looking behind the nominee accounts, because most shares in the UK are held in nominee accounts, and just knowing the nominee doesn't really help you with the beneficial owner, but Argus Vickers has a database constructed over time that identifies who is behind each beneficial owner. It's the same work that the ONS does.
Okay, if you could summarise the highlights of your research for us.
So I think the survey brings out two themes, and these two themes have been running for some years now according to the ONS. The first is that the rest of the world investor, i.e. investors outside the UK, own most of the market. Now if you put this into a historic context, the ONS first started their surveys back in 1963. 1963, the rest of world investors owned about 7% of the London stock market. Even though there were companies like ICI, which were international businesses, even though there was what you might call the old colonials, plantation companies, for example, overseas investors were still a very small part of the London market. And in fact, the figure fell from 7% in the subsequent years. It got down to about 3.5% by the mid-80s. But of course, the London markets had a revolution in 1986 with Big Bang. They became much more international. They became over time, or they have become over time, the venue of choice for listing. So for example, all the South African companies, once apartheid came to an end, came to London. So these companies have come to London, and obviously they've brought with them overseas investors. These overseas investors now represent something over 50% of the market. They own more than 50% of the market, whether you look at our survey or whether you look at the ONS survey. That's the first theme, and that continues to be the case. The second theme is the growth of the retail investor or the individual investor. Putting it into context again, back in 1963, when the ONS first carried out a survey, they owned 54% of the London stock market, more than half. They were far more important than institutional investors. That gradually declined over the years to a low of about 10% in 2012. And I think that was driven by people moving towards collective forms of investment, unit trusts, investment trusts, those sorts of things, and holding fewer shares themselves individually. What the surveys show, and what ours confirm, and the latest ONS data confirm, is that that is changing. And we've moved from the low point of 10%. If you look at the ONS data, it's suggesting 13.5% is the latest figure. But when you look in detail at markets, they're even more important than that, and they're particularly more important for liquidity.
Okay, why?
Why are they more important? Well, first of all, the amount they own of the market varies. So they own about 10 or 11% of the FTSE. They own about 20% of the non-FTSE main listed stocks. They own more like 25% of AIM and 50% of NEX. The second reason why they're important is that just looking at their ownership of the market disguises the liquidity. Now, liquidity has become a much more important thing for investors, for professional investors, post the events at Woodford. And by liquidity, I mean how easy is it to buy and sell shares? And institutional investors are under quite a lot of pressure to pay attention to this, and many of them, in fact, if not all of them now, will use liquidity as one of the factors in deciding whether they will buy a company's shares. Retail investors are important to it because for most companies, on most days, they form the share price. So if you were to take a cut of the market and divide up all the companies in the market by the average trade size, we took an example in November, but I can tell you if you look back over time, it's exactly the same. If you look at AIM, 85% of companies have an average trade size of less than £10,000. Now, we can't know who's behind each trade because obviously that is not disclosed, but it would not be an unreasonable assumption to say that the lower the average trade size, the more likely it is that it's the retail investor.
What would an institutional trading pattern look like? Much higher than £10,000
oh, absolutely,
per trade?
Absolutely, hundreds of thousands of pounds. So what you see for many shares is that there are occasionally big trades go through, there are days when there's lots of volume, and then in between there are lots of small trades that form the share price. Now, I gave the figure for AIM, and you might say, well, that's because that's dominated by the retail investor. It must be different on the main market, so that's FTSE and the 350.
It's a fair point.
Well, it is different, but it's not that much different. If you use the same metric, what percentage of companies have an average trade size of less than £10,000? It's about 75% compared to 85% for AIM. So, as I say,
this is true even for the main market.
Yes, yes. So for most companies, on most days, most trading days of the year, the retail investor is critical to price formation.
Okay, talk me through who the rest of the world. Overseas investors now dominate the main market, the FTSE 250. So what kind of investors are they? And frankly, how do you communicate with them if they're overseas?
So they are a combination of all the other sorts of investors in the UK. The biggest part is actually institutional investors, overseas institutional investors, being attracted to London by the fact that you can buy international businesses that just happen to be quoted in London. Fund management groups have become more global in their outlook, but in there you've got retail investors, you've got banks, charities, all those sorts of things.
Okay, and retail investors on the AIM market. Talk me through the shareholder, the typical shareholder structure of AIM.
So they tend to be really very important to the market. As I said, they account for something over 25% of the total market. They're very important to price formation. I mean, there are plenty of companies who would come to us and say, look, I kind of get it. When we're doing a big placing or there's a big chunk of stock that's around, it'll be institutions that'll be on the other side of it because they can deal in size and they can make decisions very quickly. Mm-hmm. But the price at which that trade happens starts from the price in the market in the day or the days and weeks before. Might be at a discount to that price, might be at a premium to that price. But that price has been set by lots of little trades. So you might describe it as the tail wagging the dog, but in reality, that's what happens in most companies most of the time. So
retail investors do feel a little bit hard done by most of the time, and they think that the institutions get the lion's share of a company's attention. To what extent is that actually true?
That is true, and I think that reflects a lack of understanding in the capital markets about the role of the retail investor, which I've just illuminated. Mm-hmm. And I think that managements, brokers spend all of their time, or most of their time, talking to institutional investors. They might talk to some wealth managers as well. And for many of them, not all of them, but for many of them, retail investors might even be an irritant in their view.
There are so many of them.
There are so many of them. They have to be addressed in a different sort of way. Mm-hmm. They've got different requirements. But they can often be very, very good shareholders. They can be quite loyal shareholders. They don't have a quarterly benchmark that most institutional investors would have.
And they don't have restrictions the way the institutions have.
They don't have those restrictions. And, sometimes people think of retail investors as all the same thing. They're not. There's a spectrum of them. There's a spectrum of them both in terms of the size that they might invest.
How would you define the retail investor?
Well, I think the spectrum runs from people who are very serious about their investing strategy, spend quite a lot of time on it. Some people spend most of their time understanding the companies in which they invest, thinking about it, thinking about which other companies they might want to invest in, and they can be very sizable investors. At the other end of the spectrum, I describe it as a spectrum of people for whom investing in the stock market is an alternative to betting on the horses, quite frankly. So, there is a spectrum.
We
There's
have
not
those
one
people on the
sort
London
of thing.
South East chat board. Okay, fair play. And if you actually want to reach out to a wider spectrum of investor, you touch upon that in your note. What is your advice? How do you reach out to a more diverse investor audience?
Yeah, so I think there's quite a lot of things you can do. I think what you've got to understand, actually, whether it's an institutional investor or a retail investor, is that in London there's about 2,000 companies quoted, so investors have got plenty of choice. And if you're a company, you need to get your message across to them. You need to get the key elements of your investment case to them. The retail investors, as we said earlier, tends to get left out and neglected. And I think there are a number of fairly easy steps managements can take to improve their engagement. So the first is, when you publish a set of results, that's a great opportunity to explain your business, to explain the investment message. But often it's not used properly. So most companies on the day of the results hold an analyst meeting at which the analysts and brokers come along and can get a presentation and can ask detailed questions. And that happens because people think of the brokers, analysts as being a way of communicating with the market, and it certainly is. But I don't see any reason why you shouldn't put the slide pack that's used up on the website so that every sort of investor can read it. I go along to these probably most days of the week. You get a slide pack, that prompts some questions. There's more.
Do most companies not actually put the slide pack up and make it available?
No, they don't.
Interesting.
There's no reason why they can't do it. There's often material in there that's not in the results statement on the RNS that gives you a lot of background, useful information in understanding it. So I think the slide pack should always be up on the website. Some companies have started to record the meeting. Might be an audio recording, might be a video, and put that up. So I think that's useful as well.
I would say it's best practice.
I agree. The second thing that some companies have started to move towards, which I think one would recommend, is capital markets days. So what will often happen is that at the AGM or after the AGM, they will then put on an event for the investors attending it that will, for example, be addressed by divisional heads, somebody who's in charge of client marketing, that sort of thing. So you get to hear more about the company than just what the CEO or CFO would tell you. So it gives you a much broader understanding and insight. Those are becoming more popular. That's a good way of doing so. Obviously, getting more research written about you. Might as well put a plug in for Hardman Co and sponsored research.
Very controversial post-MiFID.
Yes.
Would you say there's less research written about companies?
Well, I think there's two things. So there's been a reduction in the number of analysts. For some companies that has meant fewer analysts are covering them, but certainly the quantity of work that's produced by analysts per company has gone down, and more importantly after MiFID II, the distribution of that research has been severely restricted. That was the main point of MiFID II, whereas a house such as ours, a sponsored research house like Hardman, our research can be made available to every sort of investor and is read by every sort of investor, from the world's largest institutions through to retail. So getting your message across through research that explains, that helps you to understand as an investor what the key financial levers in the business are, what the risks and the opportunities in the business are, what the peer group looks like, what the peer group valuations are, I think is a valuable thing to do. I think understanding your share register and understanding, as importantly, the share register of your peer group is also a good thing for managements to do. So,
why should you be looking at your peer group share register?
Well, so if an investor holds shares in something like you but doesn't hold you, you should be going and asking that investor, well, why not? That's a pretty good source of finding new investors and finding out how your company is viewed in the market. I think using services, there are a number of retail financial services out there that you can engage with. London South East is one of them, clearly, as a way of getting your message across. I mean, that's a good idea.
And you mentioned Mello.
Mello is a good thing. So there are a number of retail investor events that take place. Mello, I think, is a great example where 700 odd retail investors turn up over a course of 2 days or so to hear a series of presentations by company management. They're desperate. They're desperate to meet company management. Often, the only chance they get to meet company management is at the AGM, which is a fairly perfunctory affair generally, whereas institutional investors, can ring up and see a company at a moment's notice. That's generally denied to the retail investor. And the other thing I look at is when companies are raising money, either through an IPO or in a secondary fundraise, there's a real risk in not engaging with the retail investor. So, I think there are some services now starting to be developed. So Primary Bidder's got one in association with the London Stock Exchange that enables retail investors to take part in secondary fundraisings at the same time and at the same price as institutional investors.
At the same time and the same price.
The same price is critical, absolutely.
Oh, so often I hear that's not the case. Keith, thank you very much indeed for joining us. That was absolutely fascinating. Thank you for having done the research, and thank you for sharing with us today. I hope you enjoyed that.